All right, foreclosures, yeah, they're making a comeback. They are tracking pretty much at the same pace now as they were pre-COVID. So the numbers are starting to spike out. If you annualize it, you can see we're back to kind of like 2018 levels. So here we go, folks. Welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns. Today is July the 17th. Randy here putting the reels in back in real estate. Hope you're doing well. Yep, stuff is starting to happen. It's going to change the marketplace. So Adam Data Solutions puts out their, we'll say in this case, it's their first half of 2023 foreclosure, I guess you could say report or synopsis. So foreclosure activity is in the first half of 2023 ticks upward towards pre-COVID levels. So basically, we're looking at it's a foreclosure market report which shows there were a total of 158,580 U.S. properties with foreclosure filings, default notices, and scheduled auctions or bank repos in the first 6 months of 2023. That figure is up 13% from the same time a year ago and up 185% from the same time 2 years ago. So yes, things are starting to happen and things are starting to change in the foreclosure world here. So basically, we're gradually approaching pre-pandemic levels. I'll show you how it plays out, but we're kind of already there, all right, if you sort of annualize it, seasonally annualized type of thing. So the typical states always leading in foreclosure rates. So we basically had highest foreclosure rates for the first half of 2023 were Illinois, New Jersey, Maryland, Delaware, and Ohio. That's pretty much typical for what we see. Other states that had pretty high rates were South Carolina, Florida, Nevada, Indiana, and Connecticut. Only one that wasn't in there was California, but I'm sure it's right around the corner. It's going to be there from a complete volume perspective. So again, our old friends, the states that always had them back in the last housing crisis, are having them again. So there should be no surprise there. Highest metros, so we have with a population base of at least 200,000 people. Highest rates for Cleveland, Ohio, Atlantic City, New Jersey, Fayetteville, North Carolina, Columbia, South Carolina, and Lakeland, Florida. Lakeland's about an hour from where I'm at. Other major areas, Metro Chicago, Jacksonville, Florence, South Carolina, Philadelphia, and Elkhart, Indiana. So, yeah, we're rounding out what's sort of been going on. Foreclosure starts up 15% from last year. This is actually the sort of stats that I like to look at. Bank repos and stuff like that, other foreclosure activity, that's part of the whole process, but really we can't control when the bank repossesses, etc. So that's why the foreclosure starts are important, because the foreclosure starts basically show us who is now facing foreclosure, who's got a problem they have to deal with, and gives us an idea of what's happening in the economy at the local metro level, etc. So essentially, up 15% from the first half of last year and up 36% from the first half of 2020. So just, when we sort of hit February of 2020, mid to end February, the COVID pandemic was hitting us, and the moratorium, the foreclosure and eviction moratorium came in. So that's why they're doing the comparison at that point in time. States that saw the greatest number of foreclosure starts in the first half of 2023. So this is just pure volume. California with over 14,000, Florida with almost 14,000, Texas 13,400 and change, New York about 8,700, and Illinois just shy of 8,000 foreclosure starts. So your top states, as far as population are concerned, certainly had top numbers as far as foreclosures fines are concerned. And again, no surprise, it's the demographic, that's the volume, it's the way it plays out here. Bank repos were up, of course, so 9% from the first half of 2022 and 133% from the first half of 2021, but down from 40% from the first half of 2020. Again, states that have a lot of repos, which is bank REOs, so things are being taken back. Michigan, Illinois, Pennsylvania, California, New York. All right, so again, heavily populated states. REOs, repos, etc., do take a bit of time to go run through the system. We'll talk about that in a second here. So this thing actually bothered me. All right, this next slide here says Q2 foreclosure activity below pre-recession averages in 78% of major markets. So when you look at that headline, you think, oh, it's below pre-recession averages in 78% of the marketplace. Oh, obviously not much going on. Oh, not much of an impact. But this is what they're doing, or this is where they're saying pre-recession. They're basically saying pre-recession was from Q1 2006 to Q3 2007. So we're going back basically how many years now? We're talking 13 years, 16, 17 years. They're comparing today's foreclosure activity all the way back 17 years ago when things started to fall apart in the last or the first housing bubble we experienced. So that's the thing. So again, I think it's a little bit of a stretch, a little bit of a red herring there. And again, this goes back to the narrative. So what I don't like is again, it's like, hey, foreclosures aren't a problem. It's okay. Don't worry about them. Don't look over here. Look over there. Go buy that property at the high interest rate and high price points. Okay, that's what all these groups want you to do. All right, it's changing the narrative. I've talked about that many times. We know narratives are basically what makes the world go round these days, right? So again, don't like this position in the slide because you know what? If we're comparing, yeah, it is 65% below the recession or pre-recession back, whatever, 16, 17 years ago. So come on, man. All right. Again, we see just again up 2% from the previous quarter and up 8% from a year ago. Simple as that. So again, previous quarter, again, foreclosures run in cycles. They file in cycles, so I track that. So in the end, you take a look at the year, you see what happens, or you take a look at the half year, the quarter. So again, a little bit ebbs and flows, but the point though is that we're increasing, we're getting back to where things are going to be or where they should be, comparatively speaking. Now, this article also has the chart with respect to foreclosure market by date. So basically, we're looking at, this is all the 50 states plus DC. I'm just going to highlight the top 10 states. So we got Delaware at number 4, Florida at number 7, Illinois, of course, number 1 for the rate, Indiana number 9, Maryland number 3. All right. What else we got going on here? We've got Nevada at number 8. We've got Jersey at number 2, Ohio at number 5, South Carolina at number 6. I'd like to note Michigan, even though it's number 11, didn't make the top 10, had over 7,000 filings, so they're kind of up there in volume. North Carolina, number 18, had 5,700 filings. So, we're seeing some changes in some of the marketplaces here. Your last slide didn't have anybody in the top 10, but realize that Texas at number 19 did have almost 14,000 filings for the first half of the year. So again, you may not be high on the rate, but you're high as a state on the actual pay count of volume. And that's, to me, it just, again, you can cut this or dissect this or statistically analyze this any way you want. In the end, it's all about the volume and whether you can get your hands on it or not here too. Now, just to show you the activity. So here we are in 2023, with so far for the year, we're at 185, I guess we'll call it activity, all right? And if you want to compare that, well, obviously 2022 is less. 2021 was a very small number. We were right in the throes of the eviction moratorium and foreclosure moratorium. And 2020 had 165,000. That was when COVID started. Obviously, before COVID, so that's why I'm saying, we're tracking. So that 185 is basically 6 months worth. So if you extrapolate that out, just very simply go, okay, well, let's double it. If it's 185 for 6 months, what are we going to, if we just double it for the other 6 months, we're going to be at what? We're going to be at 185 times 2 is, 360. We're going to be at 370, 371. And that puts us a little higher than the foreclosure activity back in 2018. So if you say we're sort of recovering or kind of almost at, well, I think we're at pre-COVID, all right? So there you go. So basically, we're at the levels of 2018 as far as foreclosure activity is concerned, and we're at the tip of the iceberg. All these statistics that we hear out there about the foreclosure activity, I can tell you the data is not captured. Well, number one, the data is shown to us the way they want us to see it. So we always know that it's always underestimated. So there's more there than meets the eye. We also know there's a big concerted effort not to alarm us or make us look weak or scare the people in the housing market, because the last thing lenders and the real estate professionals want you to do is go, I'm going to wait another 6 months or a year to buy a property. I'm going to wait to the price points go down and there's more opportunity. They don't want you to do that, so they're not going to show you where the market currently is. So again, here we are, first half of 2023. If you extrapolate where we are with the data, we're already tracking greater than the pre-COVID 2018 foreclosure activity as shown here by Adam Data Solutions. So it should not come as a surprise that things are starting to change in the marketplace. All right, now folks, if you enjoy the information that I provide here and my take and spin on the housing bubble, if you could please hit that subscribe button, I'd really appreciate that. And if you're currently a subscriber, do me a favor, hit resubscribe, hit the bell notifications. Again, I lose subscribers every day for unknown reasons, so if you could do that, that would be great. And I get your emails, I look at the comments when you do say, yeah, I thought I was a subscriber, and I noticed I was not subscribed anymore, or I am a subscriber, I'm not getting your notifications. So we know stuff is going on behind the scenes on this channel. All right, so top 10 U.S. housing markets with the worst foreclosure rates in 2023 for Q2. So if you want to go to Q2 2023, so that first article from Adam was based on the first half, so Q1 and Q2 combined as a summary. This is just talking about the foreclosure rate specifically for Q2 2023. But again, according to the report, figures up 13% from the same time period a year ago and 185% from the same time period 2 years ago. So again, activity is up, it's increasing, and honestly, as I said, we're not even scraping the top or at the bottom of the barrel yet. We're nowhere near the top here. So, all right, so the top 10 U.S. housing markets with the worst foreclosure rates: Atlantic City, New Jersey; Lakeland, Winter Haven, Florida; their metros: Cleveland, Cleveland, Ohio area; Columbia, South Carolina; Jacksonville, Florida; Palm Bay, Melbourne; Titusville, Florida; Elkhart, Goshen, Indiana; Ocala, Florida; Chicago, Naperville, and Elgin, Illinois; and Orlando, Kissimmee, Sanford, Florida. So that's your top 10 housing markets with the worst foreclosure rates. Now again, foreclosure rates is not necessarily a peg count. It's the I guess you could say the ratio of how many one foreclosure per how many homes. It's the ratio. So interesting to note that 5 of the top 10 foreclosure or housing markets with the worst foreclosure rates for last quarter are in Florida. Again, Lakeland, not too far from me. Jacksonville, but a little bit farther, 4 hours up the road. Palm Bay, Melbourne, Titusville, straight shot across I-4. Ocala, about 90 minutes east from where I'm at. And Orlando, Kissimmee, same thing, about hour 10, hour 20, depending on whether you're in Kissimmee or Sanford. Orlando's in the middle. But the point being is that we're seeing a significant increase in activity on the foreclosure world. This is something I track, as you know, all the time. We've put in a lot of effort. We're getting deals. We're closing deals. We're, I guess you could say, further doing data analysis and trying to figure stuff out. We got some really great systems and ways we can help homeowners, settle their debt and move forward and things like that. So we do a lot of activity and will increase over the next little while. So for anybody who's interested in figuring this stuff out, this is what you should be looking at. These are where the deals are at. All right, they really are. I mean, if you want to work on the investment side, this is a market that's not touched. If you talk to me, I can show you that nobody or very, very few people are doing this business. The impact is almost zero to the housing market. So all this is kind of bubbling and boiling underground like a geyser or like a volcano ready to erupt, and it's slowly percolating away, and it's going to happen at some point in time. So the point that I like to make is that be ahead of the game. Look at the stats. I've been talking about these stats for almost 5 years right now, and we've seen the market go from highs to some lows to some highs. We've seen the foreclosures run in a big cycle as well too. Now we're basically on the downslide. We've already peaked. We peaked back in the fall of 2022, or just before that, and we're sliding now. We're not seeing the major summer selling season. We're not seeing any more major real upticks in housing prices. And that's all with the current environment, economics, the whole bit. That's with basically the foreclosures having no impact on the current housing market because they're not quite here yet. But they're here. You just got to go fishing for them and find out how to access them. But again, from as far as a public retail perspective, they're not actually here right now. So that's kind of scoop. If you want to know where I get my information, just go to gethousingdata.com. I have an affiliate link with gethousingdata.com. Check it out. It's my partnership with foreclosure.com. You can really easily sign up for a very inexpensive monthly fee, see what's going on in your neck of the woods, your own backyard, what's happening in your county or city, whatever. It gives you an indication. So all these, all my stuff I talk about, which is foreclosures increasing, yeah, start tracking them. They are increasing. Start looking at what's going to auction. It is increasing. What's getting filed is increasing. Everywhere across the board, the numbers are up. It just depends on your metro and how much they're up. But pretty much the majority of locations across the U.S. are seeing an increase in foreclosure filings and overall foreclosure activity. So please keep that in mind. Now, as obviously I talk about this all the time as well too, this is the top 10 ways to earn income and build wealth in this marketplace right now. You can go to the foreclosure auction, buy at the foreclosure auction. Most of them are online. Some of them are actually in person still. You can go afterwards, go to the bank-owned websites and these other third-party sites and try to buy or bid for REOs, which are real estate-owned, bank-owned properties. Obviously, do what I focus on: short sales, short payoffs. Take the property over subject to the mortgage. Some great opportunities there. Delve into the homeowners association, condo association foreclosures. That's a whole other niche market there. Tax deed foreclosures, great opportunities, niche market as well too. Probate and estate foreclosures. People are passing away. In certain states, there's a higher rate of mortality going on with respect to people that are aging out in southern states, etc. Also, we've had a lot more increase in just overall fatality, mortality, etc. After the COVID scenario. So there's a lot more people that are passing away and leaving these open estates that need to actually have some help clean up the mess. Zombie houses, foreclosures, it's a favorite of mine. Obviously, lots of houses, people just abandon them. They walk away, they don't know what to do. Great opportunities there. Underinsured, whether you have tornadoes or flooding or hurricanes or fires, many times people are ill prepared and they're underinsured, and they'll just take a quick settlement to walk away, and those are opportunity properties right there. So look at that. Also, what's called surplus or overage. This happens when what? There's an auction that takes place, typically a county or for a state or county auction, tax deed auction, etc., mortgage foreclosure auction, and a third-party bidder bids enough to pay off the final judgment, and there's surplus there. That surplus is entitled to the owner, and there's a whole niche market opportunity to help those people get access to their money, and you can earn some along the way. Because remember, they don't get a check in the mail for the surplus, and nobody at the county courthouse or the county offices are calling them saying, "Hey, Mr. and Mrs. Smith, we got some extra money for you. Come on and get it." So it doesn't work that way. So great opportunity to sort of do all this at once, which is what we do. So if you want more information about that, please connect with me. I'll hook you up. I've got my training programs we're launching. I'm always changing them and doing what I can. But I can tell you right now, the market is changing. Activity is changing. People are now looking at all these things I'm talking to because they realize that with high interest rates and high property prices and lack of inventory, you got to go someplace else to find the good deals, and that's what typically happens. So once again, everybody, thank you for the views, likes, and comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe, and we'll look forward to speaking with you later on this week. Thanks.